What's up everybody, Jaspreet Singh here, and the stock market has been rallying, and this has a lot of people feeling like the economy is recovering, the worst is over, inflation is starting to come down. But is this the case? Well, we've been seeing the stock market rally and we're seeing inflation come down. Like gas prices have come down, real estate prices have come down. We are seeing the prices of things in stores starting to come down. Like Walmart and Target have been doing a bunch of liquidation sales because they bought so much inventory, people haven't been able to buy it. So what does this mean? Well, there's a couple different things going on. Let me first start by talking about inflation, then I'll talk about the stock market because that'll help tie everything together. On the inflation side, yes, we're going to see inflation fall for at least this month, the next couple months, because we're seeing, like I just discussed, gas prices have come down. We're seeing the price of products in stores start to come down. We're seeing real estate come down slightly. And so these things are making life slightly easier for people because we're seeing the prices of things start to come down. Now, they haven't had a drastic drop in prices. However, we are seeing the price of some things come down. So I do expect the next inflation report or next few inflation reports to be lower, which will be great news for people because that means that you have a little bit more buying power with your salary, with your earnings, with your savings. On the second side, which is the economic side, we are seeing the opposite happen. That we're seeing a slowdown in the economy, and we're seeing the slowdown continue. Like we already saw the first quarter and second quarter economic GDP report come out, and they said that our economy has been shrinking for the first 6 months of 2022, and we're continuing to see this happen. I made a video last week talking about this, where pretty much across the board, companies are either now laying employees off if they were overbloated, or if you have a strong company, now you're asking your employees to be more productive, to get more done, to earn more money per employee because the companies aren't making as much money. Or the third thing is you're not hiring more people because now our job openings are at the lowest levels in the last almost year. So companies are looking for less employees. They need more out of their employees, and if they're bloated, they're letting people go. So that's kind of what we're seeing happen on the economic side, but the stock market has been booming. And now the question is why? Well, there's a few reasons. And the first thing that you have to understand is that the stock market and the economy, while they are correlated, they're not always directly linked. They're not always linearly correlated, meaning if the stock market goes up, that doesn't always mean that the economy is going up. So you got to understand that you're going to see in the short term a variation between the stock market and the economy, but over the long term, you do see the stock market and the economy start to kind of connect and correlate. And what's happening right now is people are kind of predicting that because we're starting to see inflation come down, this is going to be fuel for the Federal Reserve Bank then to stop raising interest rates, to stop doing quantitative tightening, and to actually do the opposite, quantitative easing. Because up until now, the Federal Reserve Bank, which is the central bank of the United States, they control the monetary supply. They have been working to do two things. One, they've been working to raise interest rates, and two, they've been working to sell off some of their assets. So raising interest rates, what does that do? That makes borrowing money more expensive. It makes it more expensive to get a mortgage, makes it more expensive to buy a car, makes it more expensive to have credit card debt. So it makes spending money more expensive. And quantitative tightening adds more liquidity into markets, meaning they sell off some of the bonds that they own because they printed trillions of dollars in 2020 and 2021. So they built up this huge balance sheet and now they're trying to sell it off. And this is what is now starting to enter the market. Now, they haven't done too much of this type of quantitative tightening. They're saying that now they're really going to start it, and by September they're going to hit it full force. So we'll see what they actually will do that. But now you have a lot of people on Wall Street, which, by the way, Wall Street is only like a 10-minute walk from here. So I've been trying to get the sentiment and feel of things happening on Wall Street. A lot of people on Wall Street feel that coming soon, the Federal Reserve Bank is no longer going to be raising interest rates. They're not going to be raising interest rates aggressively. They might even start cutting interest rates, which would make spending easier, more affordable, and the Fed is going to contribute to making a bigger boom, to stimulating. Now, if they do that, that will be great for speculative assets, things like tech companies, things like crypto. We've been seeing, crypto start to recover. But again, this does not mean that the worst is over. There's a lot of things that you want to pay attention to. Now, of course, if you do want to invest your money in things like crypto or stocks, you want to make sure that you're using a reputable brokerage. If you're looking for a good one, you can check out our sponsor, FTX US. I've talked about FTX US many times. They are the company that has helped bail out many of the bad crypto exchanges. Like, they gave a lot of money to BlockFi. They even bought a big chunk of Robinhood. And the nice thing about FTX US is that not only can you trade crypto and NFTs, but now you can also trade stocks right off of their platform. So they allow you to do pretty much everything right off of their platform, and they make dollar cost averaging super simple. Like, if you wanted to buy Bitcoin and you want to buy it every day, you just have to enter in whatever crypto you want to buy, and then you can pick the frequency. You want to buy it once a month, once a week, once a day, and so you can pick the frequency. And the best part is that their fees are some of the lowest in the industry, so more of your money can go to actually buying you the assets that you want, whether it's stocks or crypto, and less money is going to just make your brokerage richer. So if you want to learn more and see how you can use FTX US, and you want to get some free crypto, because they have a promo going on right now, that if you use my referral link down in this description below, and then you enter in the referral code minority, they will give you some free crypto after you trade $100 on their app. So if you want to learn more, I'll put the link to how you can do it with their sponsor, FTX US, down in the description below. So now this brings me now to the whole topic of, what does this mean for the stock market, and where's the stock market going to go? Well, there's no way to predict what the Federal Reserve Bank is going to do. So let's talk about a few different things. Let's talk first about if we ignore the Federal Reserve Bank. If our economy is slowing, well, eventually that's going to trickle down into the stock market, because it does look like our economy is going to continue to slow. And if you are of the belief that we are in a recession right now, even though the Fed and the government don't believe that we're in a recession, but if you believe that we're in a recession and that this recession is going to continue to get worse, this will trickle down into the stock market, because the economy is going to slow. That's going to hurt businesses, it's going to hurt profits, and that's going to hurt valuations, meaning the stock market will fall. Now, let's take this one step further now, because our economy and stock market doesn't work in a vacuum. We also have this external factor called the Federal Reserve Bank that's kind of putting their fist and hand into the markets and the economy. So the Federal Reserve Bank can then kind of manipulate this, because then they can pump money into or out of the economy and the markets. Now, as of today, the time I'm recording this video, the Federal Reserve Bank is saying that they want to get inflation down to 2%. And until it's down to around 2%, they're not going to start stimulating, meaning they're not going to pump more money into markets until inflation has significantly dropped to 2%. Now, if they stay true with that, it's going to take more quantitative tightening, and it's going to take more interest rate hikes to do that. So if they stay true with what they say, that will pull the economy into a recession, most likely, and that is going to hurt the stock market. So that's now if the Fed stays true with what they say. However, there's also the chance that the Fed doesn't stay true with what they say, because the Federal Reserve Bank could, some months down the line, say, okay, yeah, we wanted to wait until inflation came down to 2% before we started stimulating, but the economic slowdown is now more important than inflation. Because if, let's just say, a number of months from now, we start to see the economy slow down more, we start to see more layoffs, we see maybe a bankruptcy or two that are kind of significant, the Federal Reserve might say the economy is slowing down more significantly, and we need to take this seriously, and we cannot have an economic slowdown right now. And if they say now that the economic slowdown is more important than the high inflation, then they might start stimulating, cutting interest rates, and that could push then markets higher, because now they are pumping up the markets. It's literally like blowing up a balloon, where you're putting more hot air into the balloon. In this case, it's dollars, and the Federal Reserve Bank can control that money printer. Now, of course, there's a cost to them doing that, which is the inflation. We're all paying the price of inflation right now, but this is the thing that you want to pay attention to, because yeah, we will see inflation start to come down right now. However, it's not coming down to 2% anytime soon. It's going to take more economic pain to do that. The question is, when is the Federal Reserve Bank going to stimulate? And the reason why now the stock market has been going opposite to what is normal, like when we hear reports of high inflation, the stock market falls, and we hear reports of a recession, the stock market rallies. Well, the reason why is because when we hear reports of a recession coming, that means that more people believe the stock market is going to be stimulated by the Federal Reserve Bank. So typically, recession would mean economic crash, stock market crash. But what people are saying is recession would mean crash, but that also means that the Fed will start stimulating and pumping money into the markets, so people get excited by the idea of a recession. And inflation would typically mean that markets should go up because people want to get out of the dollar. But people are actually taking it the opposite way now, where they're saying inflation would mean that the Fed is going to continue their fight on inflation, meaning raising interest rates. So that's going to push the economy down. And so that's causing the market to go down, which is why the stock market has been contradictory to what's normal. But this is where you don't want to just be playing this game where you're looking 2 steps ahead. You want to be looking many steps ahead and understand that, hey, if the economy really does slow down, that will affect the markets no matter what. And this is where, you got to play this game where you're not just looking at 2 steps, you're looking 10 steps ahead, and you're looking at what does this mean for the long-term health of the economy and the market. And this is where you want to be a long-term fundamental investor and not just a trader if you want to make the real money and look for the opportunities. Now, of course, we keep you updated on Market Briefs, which is my financial newsletter. So if you haven't subscribed to that, make sure you do that.
Cause the price of all assets to drop. Now, assets are things that people buy for the sole purpose of making money. And now when these asset prices drop, it's like Black Friday for investors. Now, you can come in, find some of these investments at a discounted price, and then ride up the wave, but it requires the patience and it requires the right financial education.